Welcome to Intelligent Investor Insights with Joshua Barone and Robert Barone, your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
Welcome to the show. If you've been listening to the Federal Reserve's public press conferences, you'd think we're on a smooth, pre-programmed cruise control toward interest rate cuts. But the April 2026 meeting minutes just exposed a massive chasm between what they're telling the public and what they are actually debating behind closed doors.
And the biggest shocker in those minutes is that the consensus isn't nearly as cozy as Chairman Powell makes it look on TV. We had three formal dissenters, Hammack, Kashkari, and Logan, who flat out wanted to rip up the easing bias language from the statement entirely. That is not a unified committee.
Three dissents is a historical red flag, Josh. In the modern Fed, dissent is highly discouraged. They prefer a unified front to avoid spooking the bond market. For Hammack, Kashkari, and Logan to break rank tells you that the internal models are flashing warning signs that they can no longer sweep under the rug. They are explicitly talking about a two-sided policy rate distribution, which is central bankers speak for rates might still have to go up, not down.
A two-sided distribution. Try telling that to the equity markets, which have priced in rate cuts as an absolute mathematical certainty. If the next move is actually a hike, or even just a prolonged pause, there's going to be a lot of leveraged portfolios swimming naked when the tide goes out.
The markets are completely mispricing the asymmetry here. If you read the text closely, the bar for the Fed to cut rates is extraordinarily high. They explicitly state they need either a, quote, material deterioration in the labor market or a sustained return of inflation to their target. Meanwhile, the bar to raise rates is actually much lower. Any signs of inflation reaccelerating could trigger a hike.
And that inflation threat isn't hypothetical. The March 2026 PCE nowcast printed at 3.5%. Dad, 3.5% is more than a full percentage point above their target, and it's moving the wrong way.
Exactly. And this 3.5% nowcast proves that inflation is no longer about transitory supply chain hiccups or oil prices. It has evolved into a behavioral feedback loop. Service sector inflation, fueled by sticky wage expectations, is embedding itself into the structural economy. When inflation becomes behavioral, simple monetary models break down because consumers and businesses start front-loading purchases, expecting higher prices tomorrow.
It's like trying to put out a fire when the occupants of the house are throwing dry wood onto the flames because they think wood will be more expensive next week. It's self-fulfilling.
Which brings us to the labor market. The headline unemployment rate printed at 4.3%. Now, the financial press looks at 4.3% and says, see, everything is fine, the consumer is resilient. But they are ignoring the household survey and the extreme sector concentration.
You've been beating this drum for months. If you strip out government hiring, healthcare, and leisure, the rest of the private sector is essentially flatlining. We are not creating high quality, high wage, industrial or technology jobs. We are creating part-time service roles and government administrative positions funded by a $2 trillion federal deficit.
That is exactly the point. Government-funded employment is not productive GDP growth. It is consumer demand subsidized by debt. When you have a job market built on a foundation that narrow, it's incredibly fragile. A sudden pullback in consumer discretionary spending immediately implodes the leisure and hospitality sectors. And suddenly that 4.3% unemployment rate spikes to 5.5% faster than the Fed can react.
In my practice here in Reno, I tell clients that looking at aggregate economic data is like checking the average temperature of a hospital. The average might be 98.6 degrees, but half the patients have hypothermia and the other half have a raging fever. If you're building an investment portfolio based on, quote, average stability, you're exposing yourself to massive tail risk.
Let's move to where the real fever is burning, the shadow banking system. The minutes revealed a highly unusual, detailed discussion about private credit risks, specifically focusing on payment in kind, or PIK, debt structures.
PIK debt is the ultimate kick the can mechanism. For listeners who don't live in this mud, PIK allows a borrower to pay their interest not with actual cash, but by issuing even more debt to the lender. It's essentially saying, I can't afford my mortgage payment this month, so just add it to my principal balance. We are seeing this explode in software sector private credit.
It is a balance sheet cancer, Josh. It hides defaults. If a company doesn't have the cash flow to service its debt at 9% or 10% interest rates, the lender agrees to a PIK structure to avoid marking the loan as non-performing. This keeps the lender's reported yields looking pristine, while the underlying corporate borrower is slowly suffocating under a compounding mountain of phantom debt.
And the scariest line in the entire April minutes, the one that made me sit up straight, was the Fed admitting to, quote, significant data limitations in monitoring these private credit exposures.
Data limitations is a polite central banker way of saying we are flying blind. The Fed regulates the traditional banks, but they have zero jurisdiction over private equity shops and unregulated credit funds. They don't know who owns the risk. They don't know how leveraged those funds are. And they don't know what happens when those PIK structures finally hit their maturity walls and can't refinance. It is the classic pre-crisis setup, and it connects directly to the Treasury basis trade, where hedge funds use massive leverage, sometimes 50 to 1, to exploit tiny price discrepancies between Treasury futures and cash bonds. The Fed notes that these leverage positions are back at record highs.
50 to 1 leverage on US Treasuries. That is exactly the mechanism that broke the repo market in September 2019 and nearly collapsed the entire global financial system in March 2020 before the Fed stepped in with trillions of dollars.
It is, and the fact that the minutes explicitly mention preparing swap line extensions tells you they are anticipating another global dollar liquidity squeeze. When the basis trade unwinds, everyone rushes for dollar cash at the exact same millisecond. The foreign central banks run out of dollars, and the Fed has to activate those swap lines to keep global banks from collapsing.
This is why we build portfolios designed to ride credit cycles, not fight them. You don't buy yield when the yield is manufactured by PIK accounting tricks, and you don't chase momentum when the underlying liquidity is backed by 50 to 1 leveraged hedge fund trades. You hold cash, you underwrite for the apocalypse, and you wait for the market to price risk honestly again.
Patience is the only real edge left. Until next time, keep your eyes on the actual data, not the sanitized headlines.
Thanks for joining Joshua and Robert on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late-cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation with a member of our team: Robert, Joshua, Andrea, Mike, or Eugene. and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.